I'm Kirsten Leute. I lead up our university relations efforts at Osage University Partners. We'll talk a little bit about what OUP is in just a minute, but my background, I've been with OUP now for 6 years, leading their university relations efforts. Previous to that, I actually worked in tech transfer for almost 20 years, and really happy to be here to talk with you today. Margalit?
Thanks, Kirsten. Yeah, so I'm Margalit Haber. I'm an associate on the life science investment team at OUP. And so my background is I have a PhD in neuro. Prior to OUP, I was actually a postdoc at Penn, with all you guys, and ended up spending some time in the life science startup and biotech community in Philadelphia, and then joined OUP about 2 years ago now. And I am the point of contact for life science startups at Penn in general too.
Okay. So I mentioned we talk a little bit about OUP and who we are and what we do. So this is that slide. So you don't need to read it through, but I'll give you the basics. So we're a venture capital firm that invests in startups out of academic institutions. We invest in any stage that those startups happen to be in, from early to late stage if they're looking for venture capital funding. And as Margalit mentioned, she's on our life sciences team. We also have a tech team that looks at most of the physical science opportunities coming out of those research institutions. We invest in deep science. So most of our investment team, they have deep science backgrounds, PhDs, masters, et cetera, looking into those technologies. We work with academic institutions because we think that's a terrific space to invest in. We think there are a lot of great opportunities, things that are transformative, going to change the world, coming out of those academic institutions. Our academic institutions do share in a portion of our profit based on our investing through participation rights that may be in the license agreements. It's not the only way we invest, but it is the foundation which our firm was founded around. If you ever have any questions about this, or if you're negotiating a license with Penn, we're always happy to talk with you about this. We like to know about opportunities coming out of our universities early on. So if you're starting up a company, come and talk to us. We're happy to just talk to you about venture capital and how that works and how investing in company works. And as you as a founder, perhaps on a company, your roles, now and in the future with that company. So we have a lot of experience in this, been doing it for over 10 years. We're currently on our third fund, now having between the three funds about $600 million under management. And we've made over 100, and actually this should say over 125 investments in university startup companies. And actually we have a lot more based on this year. And I apologize, this is actually, this deck is the same deck we used about a year ago with Penn, but we have a lot more IPOs that happened in the last year amongst those startup companies, because it was such an amazing year for IPOs and a lot of successful acquisitions of companies. And I already mentioned our team, but always happy to answer questions about OUP ourselves. But really the reason that all of you are here today is to talk about venture capital. So you're here to talk with us about venture capital, how it works, what that potentially means for your startup company. We're happy to delve into that. We have a lot of potential slides to get through, but we're here to answer your questions. So please, as we're going along, just raise your hand, or pipe up, and we'll answer those questions. So first we're going to start off with a review of just what how venture capital firms work. And we think this is really important for you to know, because when you're talking with a venture capital group, you need to understand why they're doing what they're doing in order to perhaps be able to speak their language and make the case for why they should invest in you. So, and many of you may already know this, so I apologize if this is a review, but just the basics. So venture capital organizations are made up of general partners who are the venture capitalists at the firms, and they manage the funds themselves and make the investment decisions. And often the general partners have other people in the group who are supporting them, principals, vice presidents, associates. Margalit already mentioned that she's an associate on our team, and analysts who are doing a lot of the heavy lifting on the actual review of possible investments. And then they're the ones who are digging in into the specifics on the companies, on the science, on the team, on their pathways, et cetera, and potentially making those recommendations of what should be invested in. The general partners go out and raise funds. So they raise capital from the limited partners. And those limited partners can be a variety of places, but obviously there are groups that have potentially large amounts of capital at their disposal to invest in different ways. And venture capital may be one of the things that they're investing in. Usually they're going to have a multitude of types of things that they're investing in, and venture capital is often seen as one of the riskier types of investment. And so typical types of limited partners are insurance companies, endowments, pensions, high net worth individuals, family offices, et cetera. And so they're going out and raising the capital from the limited partner who commit to making a certain amount of investments in a fund. And I'm going to talk about what that means in just a minute here. So when the general partners are going out and raising these funds, they're going to raise a certain fund of a certain amount. And those limited partners are going to commit to investing what they've committed to the fund. On top of the amount that they commit to invest, the limited partners also pay a management fee to the venture capital fund each year, and that goes to pay the salaries, the office expenses, the travel, everything that is needed to run the particular fund. And usually that's a 2 to 2.5% fee. Why is everyone doing this? They're doing this potentially, and this is the thesis that I would say the vast majority of funds out there, it's not of all of them, is to make good returns on that investment. And so the limited partners are investing this to get hopefully a very good return. And the limited partners actually receive 80% of the profits. So once returns start coming in, which means companies start exiting and the fund is able to sell off its shares or investment in the startup companies, they start returning that money to the limited partners. And so first they pay back the limited partners anything that they've already invested into the fund. Okay, so you're paying back what people put into the fund initially. And then there's an interest amount that is also paid back to those limited partners. And then there's the point of profits. So 80% of the profits go to limited partners and 20% goes to the general partners. And that general partners amount is often called the carried interest. Okay. Now, I talked about the fact that the limited partners commit to provide a certain amount of capital to the venture capital fund. They don't actually just give all that money right up front and say, oh, here you go, go invest this, as you see fit over time. Instead, what they do is they commit to provide the capital, and then the general partnership calls the capital as it's needed. It kind of looks out over a 3 to 6 month timeline and says, okay, I think here's about how much capital we're going to need for the next half year to year, and we'll call that capital. And they do this continually throughout the fund as they need capital until they've kind of maxed out of what was committed on the capital. So that's an important point to know, is that people don't just give the capital right up front, but they commit to give to it over time. And then I'm just going to talk a little bit more about the VC process, and then we're going to talk about startups and their capital formation. So venture funds have 10-year life cycles for the most part. This is not, again, always true. But most venture capital fund, and actually one of the things that, for example, a big announcement the last few weeks was about Sequoia, how they're kind of shifting away potentially from this model. But in general, venture capital funds have 10-year life cycles, and they're often able to extend these for about 2 years, maybe a little bit longer, and after that are liquidated. Usually the first 4 to 5 years is when the venture funds do their initial investments in companies. And so they're saying, okay, we're going to invest in these companies for this particular fund, we're also going to reserve capital for those companies for the next few years until we can get an exit event. And so there are a couple of important points here for you potentially as a startup founders to know is, one, it's important to know where a venture capital fund is in its life cycle. If they are approaching perhaps the end of their initial investment period, they're going to potentially be looking for a return sooner than if they're, say, in year one of their fund life cycle. And so you always need to be thinking about, okay, I know my company, and when I think it may have an exit, how does that match up with this particular fund and where they're at in their life cycle? So if you're thinking that your exit horizon is 15 years out, you may not be a match for a venture capital fund that has a 10-year life cycle. So just be thinking about that. The other point that I was going to make here on fund life cycles is that when funds get to the point of around year 4 and they're finishing up their initial investments in companies, is they're going to start raising their next fund. And then potentially, if you're kind of in that sweet spot of in between, you may think about, okay, when are you going to be raising? When will you be a match for this particular fund? The other point I was going to make is about the reserves. And this is that second box down there, is that for every $1 that they invest, that a venture capital group invests in you, they're typically going to be reserving $2 to $3 for your future rounds. Now, this is going to, once again, depend heavily on where you are in your fundraising and your potential exit. If you're a late stage company, there may not be reserves that the venture capital funds need to make, because your next round may be an exit event. Whereas if you're an early stage company, you're going to be looking for venture capital funds to invest in you who have capital reserved for those future rounds. You typically are going to want investors who are going to keep investing in you in subsequent rounds. I think that's everything I'm going to say here. Margalit, anything else that I should say, or are there any questions at this point about kind of the structure of venture capital funds?
I think you covered it very well.
Okay. Anyone? All right, if not, we'll move on to capital formation. So capital formation, this is about you're actually receiving capital from sources as a startup company. And this is kind of our guide to the pathway of capital that startup companies may receive to help them fund themselves as they get towards, as they do product development, product launch, et cetera. And so obviously most of the startups that we see out of universities, they're very, very well aware and very intimately aware of the grants part of this, right? You've perhaps already received funding from the federal government or from other possible areas that have helped state funds, et cetera, that have helped you initially create the research upon which this startup is founded. Then as you start moving the company perhaps out of your lab and into a startup company, there are other types of funding that you could be receiving. One of those is friends and family. We actually did a webinar on friends and family funding, and actually we had at least one, maybe both of the startups we had that were associated with Penn around friends and family funding. That was something that we did earlier this year. I can a little while later put that into the chat so people can look at that if they're interested in friends and family funding and how that works structurally. But it's a good way to kind of get that initial capital in, perhaps to get off the ground, get yourself some space, do the initial things that you need to be doing to get your startup started. Next up from that, we're moving up this slide here is potentially venture philanthropy for those areas that have perhaps those who are committed and interested in seeing outcomes in certain indications. And then angels and accelerators. This is a huge area and one that seems to be growing more all the time. Both outside accelerators or inside accelerators at academic institutions are really cropping up all over. Some are very specific on certain industries. Some are much wider, casting kind of perhaps a net around a local ecosystem. But these can be terrific places, not just for funding, but for networking and for peers and mentors that startups just really usually need in their early stages. And I know that obviously PCI and Pennovation have a lot of terrific resources in this area in particular. Then there may be crowdfunding. We don't see this an incredible amount with the types of startups that we look at. I actually can't think of one of our startups that perhaps went through this mechanism, but obviously it's something that does apply to a number of technology areas. And then we go to venture capital, which is usually when the company is raising millions of dollars for their rounds. So perhaps the companies are raising far less down here, maybe in the tens to hundreds of thousands. Venture capital, usually the companies are raising millions of dollars, not just single digit millions, tens of millions, even hundreds of millions of dollars. So that's where venture capital comes in. And then above that, and sometimes actually combined in with venture capital, are strategic investors. So corporate investors who may have an interest in a certain area, and they often have venture arms that are looking to invest in companies as well.
I'll just add that, I mean, some companies scale entire businesses on grant funding and never raise a VC dollar. It's not for every business, but like when these startups are looking to grow rapidly, venture is a good resource for that.
Good point. Yeah, venture is definitely not for everyone, and venture some people, venture isn't for them too, because they're looking to perhaps just scale, not scale perhaps quite as much. They don't want to give up shares of their company, which is something that venture does absolutely involve, and we'll talk about that a little bit. But it is something when companies really need a large capital infusion. All right, so everyone knows the story around venture capital, that it is the majority, the venture capitalists look at hundreds of startups for every one investment that they make. We currently at OUP are tracking over 7,000 companies between all the different institutions that we work with. We make about 40 investments per fund. So these are new companies that we're investing in, which means that less than 1% of the companies that are active in our database are actually moving forward and for us for consideration. That doesn't mean there's not a lot else out there that's just terrific. It just means that you end up evaluating your opportunities and deciding which ones to move forward with. The likelihood, this is actually from an article from How Do Venture Capitalists Make Decisions. I highly encourage you to read this article if this is an area that you're interested in, but it actually went through and aggregated numbers from venture capital data on how many opportunities they considered versus they actually met management with. And you can see how these numbers are getting smaller each time. We're reviewed with the partners that we exercised due diligence on, and we'll talk about due diligence and how that works in a little bit, that we offered a term sheet to and then closed on. So it rapidly scales down as you look at opportunities. And I think one of the most important things that we're going to just talk about a little bit today, but we're always happy to hone in on more with you, is getting to know your investors. When understanding venture capital, it's important to understand that no venture capital firm is like another venture capital firm, exactly alike. Venture capital firms have investment theses that they're pursuing, and you need to understand what that investment thesis is when looking at approaching a venture capital firm. I think one of the most tiresome things as in a venture capital group is to get opportunities sent to them that don't speak to their thesis at all, because it just indicates that the person hasn't done their homework. So one thing we're going to try to get the message is do your homework on the venture capital firms that you approach. So understand where it is that they invest and then who is investing in those areas within that venture capital firm. So I would say that these slides are probably a little bit out of date because venture capital firms themselves, and it's another reason you need to do your homework, change. And they may start investing earlier. They may decide to switch to later. They may start including more indications. They may, so just always do your homework. And so this slide is just to give an idea to you of different venture capital firms and where they invest. And so we have these divided up by therapeutics and all life sciences. And again, like these are old, so this information may very well be out of date, but understand where it is that they typically like to invest. One of the things that we noted a number of years ago is these crossover investors. They used to invest very late in life science firms. They have started moving earlier and earlier, honestly, to the point of company formation now for a number of these. So it's been a really interesting for those of us in investing, really interesting to see this move, this shift earlier, which probably partially reflects that there's just so much capital available out there, but also so many terrific opportunities in the life sciences. And then I think this is mainly a life sciences audience. So I'm not going to go into the tech slide. We're always happy to. But I want to save our time for Margalit's comments on particularly things that she actually works on as a venture capitalist. So I'm going to go really quickly into founders equity, and then we're going to go more on what a venture capital firm does and how it makes its decisions. So founders equity, we just have a few slides on this. I'm going to actually post in the chat in just a little bit, although it was in there earlier, but I'll post it again, just a link to our BioStar Biotech cap table example, which actually runs through a cap table and how typically that works, just because I think it's interesting for a lot of people who haven't gone through a cap table before to see how one works and how dilution works and what that means for potential outcomes for investors and founders of companies. So when you start a company, there has to be an allocation initially of that equity in the company. And so this is a semi-typical, I would say, equity distribution initially of those shares that we see in the company, perhaps with an initial CEO receiving around 40%, the co-founders and employees initially receiving 40%, and then creating an option pool. Option pools are incredibly important to startup companies. They're one of the reasons that people join startup companies in the hopes that what they are building eventually will come to fruition and be a win for everyone who's a part of the company. And so just kind of splitting that out even further, and this is kind of how we see things initially, and then moving out to further rounds, how the equity splits may happen. So perhaps that founding CEO, we said 30 to 60%, we said 40% on the last slide. Again, there's going to be some kind of range here. An active founding scientist, meaning someone who goes to the company and is a significant part of the company, may receive around this amount. A passive founding scientist, meaning someone who perhaps is on the scientific advisory board, worked on the technology initially, but isn't day-to-day with the company. That may be kind of a 1 to 5%. A range. Universities are often receiving a portion of equity then in exchange for, as part of the consideration of the license of the intellectual property associated with that. And then going down here, these are just amounts that may be considered in the future for employees that are coming to the companies. Often that initial CEO is not the CEO that is at the company perhaps 3-5 years down the road. There may be certain needs the company ends up having, and they end up changing their CEOs. This is something that your investors will look at heavily. Who is the person leading the company, and what skills does she or he bring to that company, and when are they going to be applicable for the company? And so there may be a new CEO that comes in down the line, et cetera. So your cap table is constantly changing and updating based on the people that are coming in and are receiving options or equity grants based on their positions. So I will say that this example is leaning more towards tech. We actually have just been revising this for life sciences. And so we hope to have an updated version of this, particularly for life sciences, in the near future. And so always feel free to reach out to us for that. So I'm just going to run quickly through this to give you some basics on funding and how that works for a company and what that means for equity ownership through different rounds. So we talked before about those initial splits between the founders and this initial CEO and the option pool, et cetera. In this case, we're saying that initially the company receives a $1 million financing, and they decided that the pre-money valuation for the company, what it was worth at the time, was $4 million. So the post-money then is $5 million. The post-money valuation of the company is $5 million based on that $4 million pre-money valuation and the $1 million of investment in the company. So basically the company then has the original shareholders have a 20% dilution because it's $1 million now on that post-money valuation of $20 million. And you can see through certain funding rounds here that dilution keeps happening as new investors keep coming in. So another example, in the Series A, they decided at that point the company, because they'd done certain experiments, the company was more valuable. And so it was decided that the pre-money valuation, and we're not going to go into valuation. There's a whole nother course you can do on valuation. But basically, the valuation at this point was a $10 million pre-money valuation. The investors invested $5 million. So the post-money valuation was $15 million, meaning so $5 million on a $15 million post-money valuation. That's a 33% dilution for the previous round. So again, the investors here, which is the dark navy blue, they are ending up owning more and more of the company. And the original group is diluting down, but that's okay. Dilution is natural and normal for a startup company. And what you're hoping for is, of course, that you're creating a much more valuable, and in these cases here, if you look at these pre-money valuations, they're creating a more and more valuable company as they're building up the company. And one thing sometimes we get a little bit of a question about here is that the option pool isn't regenerating. It does actually. This is a simplified version of this. If you look at our BioStar Biotech, I think we actually account for that. But this is a very simplified version of a cap table. But the main messages here is that dilution is necessary if you're going to be raising money from venture capital firms, and it's necessary then usually to get to a large exit for the company. So the other thing that you need to know is that investors, because they're investing their money, are going to get paid back first. So they usually have a preferred right. So, and again, you can go to that BioStar Biotech video if you want to learn more about this, but investors are going to get paid back first, and then the common shareholders will be paid out. There's a bit more nuance to this than what I just said. But that's one thing you always need to know is that the investors receive preferred shares, and the investors are always doing the math. They're always figuring out when what their possible multiple on the deal is and what the exit could be for them. So Margalit, I'll drive for you.
Oh, thanks. I'll let you know when to switch. One thing to note too on that, the dilution that you're taking for every round, the investors from the previous round that invested, they're also getting diluted in the mix. They have the option to buy more shares, and generally they will, and that's what they're doing with their reserves, but they're kind of putting that calculation in as well when they're investing in you. So that helps align you a little bit with your investors as well. So now we're going to get into a little bit more of like the nitty gritty in terms of what the process looks like in terms of getting an investment. We're going to start with making the pitch. So how do you pitch investors? So how do you even start the conversation with a potential VC and make it to the top of the pile. So we always recommend sort of getting an intro, right? So warm introductions really do get better responses than cold emails. We get a ton of decks. If we're getting an email from somebody we know introducing us to another company, that really helps, as opposed to a cold email, which might get kind of overlooked in the shuffle and not make it to the, not get a response right away. So ask around your network to see who they know, if they can provide you an intro. And then the next thing that will make you stand out is having a very clear and well-organized pitch presentation, impactful pitch deck. We'll go through a few more details in the next slide, but the key points to hit in that initial non-confidential pitch deck is you should discuss who you are. Are you the premier scientist in your field? Do you have any relevant experience to run a startup? It should have data that justifies your enthusiasm for this technology and address why that data is compelling in relation to the competitive landscape, right? So everything else out there in development and approved. And you want to cover the addressable market as well with regards to how big the opportunity is within realistic bounds. We find a lot of people will kind of show us an entire market overview when really the technology they're working on is going to address a small piece. So try to be as realistic as possible with that. And then finally, what your ask is. So how much money do you need and what will you accomplish with it? See, next slide. So with regards to the specific slides you should have, this slide kind of outlines what we expect to see and what we typically see in like a very good, clear pitch deck. So start with the elevator pitch. What's the problem you're solving and why is your solution optimal? Plus a line about what you are looking for from the investors to sort of preview the conversation. It just helps to have that all up front in sort of a summary slide. Then you want to talk about the team leading these efforts, include any relevant experiences from both startups and academic careers. Next, you want to go into the data, key experimental results that show why your technology or approach is better and more interesting. Anything on efficacy, safety, if it's a therapeutic, and any PK or PD or optimizations you've done. Life science VCs love data. It's not boring to us. It's what we wait to see in these decks when we're watching a pitch, and we spend the most time assessing later on. So do not worry about boring somebody with the data. Just make sure that they are the key data points and they are clear from when you're looking through the slides, even without like an audio track on top. And then for the pipeline, you want to list out your current focus and anything else potentially in the works. So you can put in, you can add a timeline on top of that. Sometimes that helps. And if you're just working on one asset, like what other indications can you expand out to? You can talk a little bit about that as well. Competition. So do your homework on this because we will do ours and find anything else out there that is approved or in clinical and preclinical development and make a case for how you compare. Maybe you're going after a specific subset, maybe you're better, but we will be assessing the entire competitive landscape when we do our diligence, and we will be comparing your technology and approach to the others. So it's better for you to come to us up front with all of that. It gives you an opportunity to make a better case. And for life science, the capital and go-to-market and milestones can potentially be condensed into 1 to 2 slides. Here you are showing like what the whole development timeline looks like and what that will cost. For therapeutics, you want to figure out how long until you're in the clinic, and for devices, you may want to look out as far as approval. It doesn't have to be an exact budget, but it should be realistic. And then cover the ask. So how much are you asking for now in this particular raise, and what key milestones will that cover? And then obviously add a summary slide at the end. It just helps kind of wrap things up. And next slide. Okay, so now you have your deck put together with regard to the pitch, and we have a few suggestions how to go about that. So when you're pitching, do not hide anything because it won't stay hidden for long. If anything, be upfront about where you see the risks of the technology and how you plan to mitigate them, because it will help show some intellectual honesty, and it will also show that you've assessed all the risks involved. Be concise and clear and compelling. Think of it like you were telling a story. It should have a beginning, middle, and end with the relevant amount of information in each part. You don't have to go overboard with all the details, but you need to provide enough information so someone can follow the story without ever hearing it before. And try to pause to allow for questions. That helps if You'll be asked a lot of questions during the pitch if the VC you're talking to is really interested and engaged. And questions are a really good sign. But with that, know that it is 100% okay to not have all the answers on the spot. It's better to admit when you don't know the answer and to offer to come back to them with the information. Again, shows intellectual honesty. And it also provides a really nice way to engage with the VC a second time. It's like an opportunity to follow up. Okay, so next slide. Okay. And then, so these are bullets taken from an article on the LifeSci VC blog. It's actually a very helpful blog written by Bruce Booth, who is a partner at Atlas. It covers various VC topics. So the article was written by the CFO and head of Corp Dev at UNAM Therapeutics. The key points to remember is when you are talking to investors, you want to pay attention to their investment strategy, stage, and fund availability, as Kirsten mentioned in the beginning. If you're a med device company, it doesn't make sense to spend a lot of time trying to talk to VCs who primarily focus on oncology therapeutics, right? Also, the fundraising process is long. We tell folks fundraising typically takes several months and possibly up to a year, depending on how much work needs to be done. So when you're an early stage company and you are telling a new story to investors, they will require time to get comfortable with that story. So expect a lot of meetings and be prepared for rejection. VCs say no a lot more than they say yes, as we have highlighted with that funnel. So fundraising is a lot of work, can take a lot of time. There is an option to outsource the process to private placement agents. However, we don't generally recommend this for early stage companies. The founders will still need to be involved in the process, even if you outsource it, because the investors will want to talk to the founders, will want to talk to the main team, will want to ask our questions directly to the people working on this. And in general, it's sort of difficult to get comfortable with a new story unless the founders are directly speaking to it and sharing their enthusiasm and going through the details and everything. You can maybe use private placement agents to help identify some funds that you can talk to and help you get connected to them. But overall, it's better to do the fundraising yourself. Okay, and then that covers sort of making the pitch. Next, we're going to go into the due diligence process.
Yeah, and before we do that though, so one thing I was going to mention, and then we also have a question. Okay. Is actually we're going to be doing a Pitching 101 webinar in January. So we're happy to send that out once we have more details to you, Lori, and you can pass it around to folks. But if pitching is something that people are interested in, we do have that coming up. And then we did have a question from the audience regarding the university founding equity. And we showed a really wide range with regards to that founding equity. And people are like, well, why? why is there that wide range? And there are a lot of reasons for that wide range. One of the main reasons is the resources perhaps the university has put into the startup company and perhaps helping build the company, et cetera. And so that may be part of the reason, that a university may have a higher equity amount in the particular technology. Another is it depends on the other deal terms associated with that particular license to the technology or perhaps portfolio of technologies that are going into the startup license agreement. So sometimes it depends on that. It also depends on the anti-dilution terms associated with the license agreement. Some different universities have different practices with regards to anti-dilution and what they're looking for that through. And then it's also just going to be situation dependent. In my experience, although there are a number of universities that have express licenses, et cetera, it's very hard to account to make everything the same because each situation tends to end up being very specific. And what really, in my experience, the universities are looking for is they're looking for a win-win deal where if the company does well, the university is going to do well. And so that's why there's this rather wide range potentially of what that initial equity consideration is going to be.
I'll say in our revamped equity breakdown too, I think we include the university portion as well as others within the cap table too. So when that comes out, we'll have a better breakdown with regards to some of those additional pieces too.
Yeah, you guys are getting all this preview, all this stuff is coming up soon.
So then with regards to the due diligence process, once you give the pitch, what happens next? If an investor is interested, we'll go into due diligence. And some of the questions that we are looking to address when we're doing our due diligence are sort of highlighted here. So all the questions kind of revolve around a few key essential items. And we're trying to figure out, like, generally, is this a good idea and a good investment? Those are not always the same thing. We're also trying to figure out if this is the right team to bring this technology forward, and is this the right time? One question we always ask is, why now? So is this the round we want to invest in? So one thing to note is the goal of this question answer process isn't always to get all the answers solidified. It's more about figuring out what is and isn't known so we can assess the biggest risks associated with the current deal. This is venture. We're dealing with early stage technologies, which means there's a lot of unknowns and a lot of risk. It's more about being comfortable with those unknowns and risks than just getting all the answers straight. So it's we like to include this slide just because it's worth understanding that there is this overarching disconnect between entrepreneurs and VCs. So every time a new deck comes to me and I'm generally flipping through the deck looking for the reasons to pass. We see so many opportunities that the only way to be efficient at this job is in passing on deals that do not meet our thresholds quickly. That's just key to doing this job well and doing it, like getting to the decks that we should be focusing on and try to screen through the others. So every time I get a deck, I'm skimming through it, trying to find those reasons to pass. Well, every entrepreneur is reaching out, hoping I will agree to a call and eventually invest. It's just worth understanding this dynamic because when you first approach VCs, so this way you can tailor your interaction accordingly. Short elevator pitch emails and clear decks that are 10 slides, not 50 slides, all of that helps us get to figure out if this could be a right fit for our fund and is greatly appreciated. So it will help you be viewed more positively as well. Next slide. Okay, so this is a slide that lays out some data that was also collected in that article we talked about, the how do venture capitalists make decisions. So they surveyed a bunch of VCs and asked them what the key factors for their investments were with regards to a successful investment. So you can see that the largest piece of the pie in both of these graphs at the moment, both the all sectors and the life science, is team. That is the most critical factor in a successful startup. This is because when things don't work out, maybe the technology fails or the market shifts, a good team can pivot and still make companies successful. After team, that initial technology, board of directors, industry, timing are more or less equal parts of the equation. In the all sectors graph, we have the life science broken out on its own because it's a little bit unique. So on the right, the life science pie, you can see team is a good portion of that, but technology is that other large section of the graph. And this is because life science startups are usually built around a specific scientific discovery. That scientific discovery or biology is critical to the startup's success. Next slide. So with regards to why startups fail, again, team seems to be the most significant contributor. The team made a misstep or couldn't recover or just couldn't pivot when something changed. Generally, the startup will fail. And then on the right, on the life science pie, you'll see that team and technology are actually just about equal, and technology just has a tiny little 2% bump up even. And that's because with life science, again, the science and the biology behind the startup are so critical to how the startup is operating and functioning and moving forward. And sometimes the science just doesn't pan out, irrespective of an incredible team that did nothing wrong in the development. Sometimes the biology just didn't work. And so in life science, that we view the team and the technology sort of on equal playing fields. So next slide. And you can kind of see this broken out a little bit in terms of what categories we focus on with regards to the diligence process. So team is the most critical component of our investment thesis and is heavily weighted in the diligence process. With regards to the different buckets, we sort of tiered them in this slide with for tech on the left and life science on the right. On the tech side, market opportunity falls under that. Does the market want and need this product? And then under market opportunity and team, once we've become comfortable with those categories, we also like to assess IP, competition, tech, capital structure, and exit. For life science, it's really team, and the science and clinical data is right underneath or sometimes on par with the team, as highlighted by those previous couple slides. The reason, reason life science venture funds hire PhDs is so we can deeply assess the technology and science. I spend the majority of my diligence trying to figure out if the science and the technology is based on very credible work and is likely to work outside of these labs. Once that checks out, everything else comes into play: IP, competition, market, indication. So when a company IPOs as the VC exit completely or hold on to percent of shares to see the company continue to build value and perhaps eventually get acquired by a big pharma for a large premium. Is the exit strategy set during the initial investment? Also, how does this play into the fund life? 10 years and the company is on track to IPO, but for various reasons get postponed. Fund is due to distribute returns. Excellent question. Very relevant to today's market as well, because we have so many, your application. Okay. We have so many companies that are going public early now, and basically changing the way our original investment thesis was playing out. So the way we think about it at OUP, and I think a lot of other funds are sort of in a similar boat, is we invested to play out to a certain data milestone for life science. It's usually preclinical or proof of concept clinical data, if generally phase 2b data in the specific indications, and that's for therapeutics. That's really where we saw an exit happening, a potential acquirer taking that company. So if the company goes public before that data point, we will hold until that data point for the most part. However, where this gets hairy is when we're doing our diligence, we make a judgment as to what that potential exit will look like. What is this company worth in success, and what will they get acquired for? What will they exit at? So on and so forth. Well, how much revenue can they make with this product? If they go public and their market cap is larger than what we thought their exit would be at that data milestone, but they haven't reached that data milestone, then we stop and we think, well, is there more value to be generated in this company? Like, do we think they can be even bigger than we initially anticipated? And that's when we start doing a lot more internal discussions with regards to, do we hold or do we sell? And then the flip side of that is if the company doesn't do so well, let's say we make assumptions about them getting some additional, like share prices going up with data releases. Some of our companies don't see that. They're seeing either stagnant share prices, or they're even seeing some drops occasionally, regardless of positive data. So then we have additional conversations internally as to whether we think this is ultimately going to be a success, and if we want to hold or not. And so each company is sort of different, but for the most part, we are making the assumption that when they go public, we will hold till that data readout. I think that. And then all of that, and again, the internal discussions are based on that 10-year fund life cycle too. So like if we've been in this investment for a long time and we're close to the end of the fund and we need to start making distributions and wrapping things up, then we take that into account as well with regards to whether we're going to hold or sell. Okay, move on to the next slide and try to go through some of these pretty quickly. So how do we diligence the team? I mentioned that team is sort of the most critical component in our investment thesis. And so what we try to do is we have a whole presentation on assessing CEOs and what are the features tied around that. And a lot of those same features we use to assess other team members as well. So some of the high level questions we are asking are listed here. First, we like to try to understand like what their track record is. Have they done any of the things that a company at this stage and this tech will have to do? If it's a clinical stage company, do they have experience running a clinical stage startup? If this company involves a heavy lift on the CMC, have they done that before? We also try to get a sense if they are putting the right plan together for the company and putting the right people around the table. Ultimately, we're trying to understand if they are easy to work with as well. Are they forthcoming with information? Are they honest about what they know and what they don't know? Are they receptive to feedback, and do they play well with others? Essentially, we'll pass on a deal if we think there isn't a good personality fit between us and the person running the company, because it's just going to make for a difficult working relationship going forward. And all this is done through reference calls with former employees, board directors, and we will talk to other investors as well to figure out if like they've had good and bad interactions with these folks too. And then just to know on the capital structure, we also review this as well. And it could make or break a deal, but it's not it's something we want to see up front, but it's not something we're like diligencing heavily on the background when we're going through the whole expensive process. But it's important to know upfront because it helps define whether it's a good fit for us and within a good strategy, right? And so then things that we want to know about the company with regards to the raise, how much have they raised previously? That will give us a sense of valuation expectations, as well as whether the new value is up, down, or flat to the previous rounds. We want to know if the syndicate's strong. So are the investors already in the company or the ones coming into the company in this round? Are they good? Do they have a good biotech track record? Do they reserve for follow-on rounds, et cetera? And then what is the purpose of this financing? So what milestones do they plan to achieve? And are they truly value inflection milestones? So do those milestones allow the company to raise the next round at a much higher valuation? And we'll assess the budget to see if it makes sense as well. And we're just going to finish up with how this whole process sort of gets concluded at our fund and results in an investment decision. And that's generally with the investment memo. So this is generally the last stage of the whole process. And it's essentially a document that we put together internally that synthesizes all our diligence and gets presented to our investment committee to discuss the opportunity that we're looking at. So this kind of just covers some of the things that we're talking about that we're putting together for the investment memo. And so the investment committee, so who are they? I should say they're the group of managing partners and partners at the fund. When we do our internal IC investment committee calls, we bring on all the principals and associates as well to participate in the discussion to kind of get everyone's feedback and viewpoints. It's really an opportunity for everyone on the team to evaluate the deal and raise objections, red flags, and ask additional questions they may have. And the company will also need to present to our investment committee as well as sort of a final step. Ultimately, it's the committee this investment committee who gives the final approval on whether we make an investment or not. And sometimes we'll go to them and they'll come back with questions and we'll go back and forth a little bit, but this could be the last step in the investment decision. And then here, this slide really just highlights the buckets of information that we put together for our investment memo. So some of the things in the memo are also categories that a company would cover in their pitch deck: management team, competition, development milestones. Term sheet summary and cap table generally come after a CDA is signed and data rooms are shared. Exit analysis can even be based on some of the info provided in the deck, along with the pros, cons, and risks of the investment as well. So the thing I think is important to remember about this is you can really help an investor get over the finish line by providing much of this information up front. Any information you can provide that can populate our internal investment memo will not only help speed up our process, it also shows that you are very well informed about the space you are operating in and understand the risks involved here. Some companies will do this by providing like FAQ documents right from the start, which are always really helpful and much appreciated. But just knowing these questions are coming, questions regarding all these different buckets, can help you be prepared for when we eventually come and ask you for that information.
Thank you so much. That was as always, great information and presentation. And we appreciate how accessible you all have made yourselves to the Penn communities interested in pursuing startups and funding.